All right, hello everyone. Welcome to our virtual HELOC webinar. With more than 20 years of experience with home equity, Jennifer Bernier will discuss the pros and cons of borrowing against your equity and review the different ways you can do so. Before we begin, I want to establish our guidelines for the call today. Everyone will be muted while we get started. If you have any questions, please hold them until Jen finishes the slide and asks for questions. If you don't want to forget them, like I would, you are more than welcome to put them in the chat. For those who are on a computer, there is a raise your hand feature that you may use as well. I will let Jen know that your hand is raised, and at that point, you may unmute yourself. All right, I think we're good to go. Let's get started, Jen.
All right, thanks everyone for joining us tonight. I am going to start with the first slide. Okay, so home equity, what is it? How you determine the equity of your home is you take the value of your home minus your outstanding mortgage balance or balances. So if your home is worth $500,000 and you owe $100,000, you have $400,000 in equity. You can build equity by making your regular monthly payments, a large down payment when you purchase the home or refinance it, and through appreciation. Appreciation occurs when the market demand rises, which is going on right now. There's a lot of market demand, so values are going up at a pretty quick and steady rate. If you do repairs or home improvements to your home, that will also raise your value. So that's pretty much the definition of home equity. Does anyone have any questions about this? No? Okay. So you have equity in your home, right? But that doesn't mean that we can borrow all of your equity. The credit union will not allow that. We protect you, the homeowner. We protect us, the lender. So I think this is about the same. Yeah, how home equity is calculated. It's going to be the value of your home minus your outstanding mortgage balances. There we go. Whoops. Okay. I'm with you. Okay. There we go. So a home equity line of credit is a second mortgage on your home. If you already have a primary mortgage, this would be a second mortgage. So it is a mortgage product. However, you can use this loan to pay down unsecured debt that would be at a higher interest rate. Personal loans, also higher interest rate and payment. It's just a way to borrow money at a much lower rate than these other options you might have, and a lower payment. Any questions? Okay, so there are really two forms of second mortgages. There's the home equity loan and there's the home equity line of credit. The home equity loan is an installment loan in which you get all of the money up front. So if you're borrowing $50,000, we give it to you all up front. You cannot borrow any further from the loan. The payment and the interest rate are a fixed amount that you just pay back monthly for the term of the loan. So it's a one-time, here's your money. Whether you spend it or not, you make payments on the money. The home equity line of credit also borrows against the equity of your home. Our product has a 15-year term, and the first 5 years of the 15, the loan is a line of credit, like a credit card. So you have access to this money for the first 5 years of the loan. You can take money, what you need as you need it, make payments based only on what you've used. The interest rate is variable based on prime, okay, because it's a line of credit. So that means if the feds get together to change rates, your rate would change. However, the credit union has caps. We have a 2% cap per year. We have a 5% cap over the life of the loan. meaning that the rate cannot fluctuate more than 2% in 1 year and never more than 5% over the entire life of the loan. So these are not volatile rates. I don't want you to get nervous when you hear variable rate. We're not going to ask for a balloon payment at the end of your draw period, nothing like that. As long as you make at least your minimum payments, you will be paid off in 15 years. You can also pay extra and pay off early. There's no prepayment penalty. Any questions about the line of credit?
Jen, we do have a question from the audience.
Okay.
Why would someone do a home equity loan over a line of credit? What's the main differences?
So the main differences would be, what's the purpose of the loan? What do you need the money for? If you are making a one-time purchase or something where you just need the money one time, you want to buy something, do something, and then just pay it back over time, that would be a reason for doing the loan. The line of credit, however, allows you a longer time to use the money. You get 5 years to access the money. So if you're doing home projects, home improvements, maybe you're building a pool, a lot of our members are doing that right now. And you know you have to pay the pool company in stages. So maybe you need $5,000 for them to start. So you'd be able to pull $5,000 from this line of credit and pay the pool company. Now you're making monthly payments only on $5,000. Then in a month or two, you owe them another $10,000. You can pull the $10,000 at that time. Now you would owe $15,000 or minus a couple of payments because you would have made a couple of payments. So the payment would then be recalculated at that new balance at the current rate for the remaining term. So if you're doing a $50,000 line of credit, you're not paying interest and making monthly payments on $50,000 from the beginning of the loan. You're only paying on based on what you've used of the line. So it really depends on the goals.
Would the interest rate be different on the home equity line of credit versus the
loan? You cut out. Is that what you were saying? Is she muted again?
Yes.
Oh, okay. Yes, typically there are different rates for a fixed rate versus a variable rate loan. So interest rates on variable rate loans are usually lower because there is that chance that they can change. But I can tell you that I've been at this credit union for almost 22 years, and we have never reached our cap, our rate cap. So rates, and what we're hearing now is the feds are probably going to leave rates unchanged for the rest of this year, which makes sense to me. I mean, and I can't guarantee anything, but with the way the economy is going, that does make sense to me. So you're paying the lower interest rate because there is that risk that it can change. Did that answer your question? Yeah.
All right, I think that one did. And then we do have one more.
Okay.
Can you claim the interest expense on your taxes?
Okay, so we cannot give you official tax advice. What I would say is to please refer to your tax preparer. And the tax laws are always changing almost every year, sometimes in the middle of the tax year. But if you use the line of credit money for home improvements, you can deduct the interest from your taxes. However, we always, just to be cautious, say, please check with your tax professional.
Perfect. I think that does answer them all.
Okay. How much can you borrow? Okay, so how much you can borrow would, of course, depend on the amount of equity that you have. And also, we do consider your debt ratio, so your income versus how much debt you have going on currently, along with your credit score. So although you may have, say, $50,000 in equity, you may not have enough equity to borrow. The credit union will allow you to go up to 85% loan to value, meaning we will not lend you 100% of your equity. So, which is, again, that's better for you, the borrower, keeps you safe from going upside down on the home if the market does take a dip. If you're at 100% and we take a little bit of a dip, you're going to automatically be upside down, which you never want to be on a home. Like most people are on their cars, you don't want to be upside down on your home. So what we do to determine how much you can borrow, we have tiers depending on your credit score, how much equity will allow you to borrow. So if the credit score is at least a 660, we will let you go to 85% loan to value. That is the maximum. Any questions on that? All right. Choosing a loan. Okay, so the loan versus the line of credit. There are differences in these loans. The interest rates are different and the closing costs are different. So the loan, the home equity loan, is again for a specific one-time cost. That would be a beneficial product for you to use if that in case is your situation. The line of credit would be used if you need to access funds over time, or maybe you just want to use $10,000 now and just leave the rest of the line of credit for a case of an emergency, or if in 3 years your water heater goes out and you don't want to use money in your account, or maybe you don't have extra money in your account to use for that, pull it from your line of credit. You really can use the money for any purpose at all. Some examples of what I've been seeing members use. A lot of members are building pools right now. Like I said, I have personally used the line of credit. We built a workshop for my husband, so a big giant garage on the side of the house. That was really nice because, again, when you're building a structure, you pay in phases. So that was really handy for us. So I didn't have to use all, $40,000 at once. I could make payments on a little bit of the money at a time. I have also done a loan for members that bought Raiders season tickets. Those suckers are not cheap, believe me. I couldn't believe the price. But anyway, so there's all this equity in their house and they're like, oh, we want to use it for this. And I was like, what a great idea. It was awesome. But anyway, so you can go on vacation for all we care. You can use it for anything you want to use it for, but to choose which product's better for yourself, if you're doing a one-time purchase and you just specifically want the money for that and that is it, loan's probably better for you. If you are unsure of how much your project's going to cost, sometimes when you're doing renovations, you open a wall and there's a whole other situation going on and that you would have needed more money for, you have access to this money over a 5-year period. As you pay down the loan, you can use the money again on this line of credit for the first 5 years. The closing costs for the home equity loan starts at about $1,500 and goes up from there. The closing costs for the line of credit, typically around $500, and it can go up from there depending on the situation, but typically we've seen between $400 and $600, so I say about $500 for the line of credit. Interest rates on the loan fixed, interest rates on the line of credit variable based on prime. Any questions about the differences?
We do have a question from the audience. Do I have to pay for an appraisal to determine the value, and how much would that be?
Okay, so not necessarily would you have to pay for a full appraisal. It will depend. For example, what we try to do is use an online valuation to determine the value of your home. Some people call it a desktop appraisal. It's just it's an online valuation that we would use at first to determine the value of the home. If you have enough equity with that particular value, because those do come in mostly lower than if we were to do a full appraisal. But if we have enough equity for what you need, the money, the amount of money you need, we will use that. So we would not require a full appraisal unless the online value is not high enough for your needs, or you want to access as much cash as you can. We can use a full appraisal. Also, if the line of credit is over $250,000 that you're requesting, then a full appraisal is required. But up to $250,000, we can try this online valuation to get the value of the home. If we are going to require the full appraisal, or you are requesting a full appraisal, the prices start at $550. That would be an out-of-pocket cost. It is the only out-of-pocket cost for the loan. So if that were the case, we would send you a credit card authorization to complete. When they call, the appraisal management company calls you to schedule an appraisal, your credit card is charged. Starting at $550, it goes up from there. If you're over 3,000 square feet, it's usually another couple $100. If it's a particularly large lot or complicated property, maybe you have like a 2-acre lot and you have a casita and a pool house, there's several different structures besides the main home, then the price would go up from there. If you live in Mount Charleston, they charge extra for driving up there. But typically around $550. We've seen a little higher if the square footage is higher. So that would be the only out-of-pocket cost if we do the full appraisal, but it's not necessarily going to be required.
Wonderful. Thanks for answering that. And we do have one more.
Okay.
My home is paid off. I want to pay off a credit card and remodel a kitchen and put in new flooring, which is recommended.
The line of credit is perfect for that, in my opinion, because you are remodeling, right? So you're doing your home projects, which again are typically money is spent in stages and phases. So instead of paying for $50,000, if you're paying interest on the entire 50 before you spend it, I'd rather just pay on what I'm using. Also, if there is no mortgage on your home, the line of credit would be the only equity loan product we could do on the home. If you wanted to do the fixed sort of loan, then that would require getting a mortgage on the home. So if you wanted to just borrow against the equity, which is less time consuming, less expensive, then the line of credit is the way we would have to go if you owe nothing on the home. Does that make sense?
I think that answers it. And we did have one more come in.
Okay.
Do we need to show proof of income?
Yes, we do need proof of income. So since our last sort of market crash, mortgage crisis, most lenders will not use a stated income loan anymore. We can't, we have to prove income. So if you are a W-2 employee, we take your last 2 pay stubs and that pretty much satisfies it. If you are self-employed, excuse me, if you are self-employed, we will use a tax return, your business tax returns and your personal tax returns, and maybe some 1099s for the current year or profit and loss statement for the current year we are in. If you are retired, then we would need the proof of your pension income or Social Security. These are really easy to obtain, by the way, if you're needing to provide us with that. But yeah, we do need proof of income. If you have direct deposit coming into your account here already, and the net amount is enough to qualify you for the loan, then we would not ask for anything. So that's also a possibility.
Oh, that's wonderful. And those are all the questions that have come in. We're good.
Awesome. All
Thank
right. Okay, so factors to consider when you are deciding what kind of loan you want to use for your projects, your goals. What's the money for? Debt consolidation, home improvements, savings. These are really the most used purposes of the loan for the line of credit. Again, for the debt consolidation, your credit card rates, I will guarantee you, are 3 to 4 to 5 to 6 times the rate that we will charge you borrowing against the equity of your home. I mean, you have the debt anyway, right? Some people get nervous about borrowing against the home, but if you have the debt anyway, why not shift it to a product that offers a much lower rate with an ending point? Also, there's a 15-year term. You make your minimum payments, you're paid off in 15 years. If you pay extra, pay off early, you can do that too. There's no prepayment penalty. When you have this debt on a credit card or credit cards, typically, personal loans, there's, if you're making minimum payments, because those payments can get hefty, there's never an ending to it, we feel like. So it is more beneficial to shift that debt to a lower rate product. Again, if you want to take the equity out in your home or some of it just for reserves, for emergency, for something you're planning on doing in months to come, maybe you're buying, a big beautiful yacht and you haven't found the one you want yet, but the money's there ready to use when you do find what you're looking for, that's another reason. Monthly payment is going to be more affordable on this 15-year term than it is going to be on these other kinds of products that people are offering you out there to do your home projects and such. So I would definitely recommend this product for these reasons and more. Any questions? No. Okay. Right to cancel. Okay. So you as a homeowner have the right to cancel this loan all the way up to 3 days after you sign your final loan document, excuse me. Up to 3 days after you sign your final loan documents, you have the right to cancel. So what'll happen is you sign your loan documents. There's a 3-day right of rescission. These are 3 business days. They include Saturdays, do not include Sundays. They do not include holidays. So 3 business days after you signed your loan, you can cancel the loan. If you do not cancel the loan would fund on the 4th day after you've signed. If you decide you want to cancel the loan after you've signed your loan documents, we give you a form you would have to complete and get back to us within that 3-day period. You can email it to us. You can walk it into a branch. You can slip it under a door if we're closed already. Any way you can get it to us, we will accept it. So there really is no pressure to do this loan from the beginning. We don't pressure you. You make an application, we send you disclosures. We have to do that, per federal guidelines. But those disclosures obligate you to nothing. All the way through the loan process, as you're giving us documents that we request and we're answering your questions, obligated to nothing. We're ready to sign. You've been approved. Everything's in order. You're ready to sign your documents. You sign your documents. You're still not obligated until the 4th day after you have signed. If you've not canceled the loan, we will fund the loan, and then the access to the money becomes available. Any questions about your right to cancel? This is, by the way, on your primary residence only. You have the right to cancel if you're borrowing against the equity in your primary residence. If you have a rental and you're borrowing against the equity there, which we're not currently doing, but we are going to be doing soon in the months to come, there is no rescission, no right to cancel on a rental property or second home, only your primary residence, okay?
How does the credit score go if you do rescind the borrowing?
It does not affect your credit at all because we would not have even funded the loan to begin with, so it never shows up on your credit. So it's not like it's on your credit and it shows, oh, you didn't pay or something. No, nothing negative on your credit like that at all. It would never show up on your credit report. Yeah. Good question. Any other questions? All right. So you've signed your loan. We fund the loan. You have access now to this line of credit. How do you access your money? We can order you a checkbook for the line of credit. If you want to pay contractors, make purchases at stores, you can write these special checks and the money would clear directly from your line of credit, not through your account. You can also come into any one of our branches, see any one of our tellers and withdraw from the line of credit in cash or cashier's check at any of our branches. You can also access the money online if you do online banking with us. If you have our mobile phone app, you can transfer the money from the line of credit directly into your credit union accounts. If you want to make payments on the home equity line of credit online, you can do that as well by transferring from your account to the actual line of credit. That would be a way to make the payment. You can also, use bill pay if you bank elsewhere. You can use bill pay to make the payments on the line of credit. Also, if you do use another financial institution for your primary banking, your checking accounts and such, I would recommend getting a checkbook for the line of credit, because instead of coming to the credit union, withdrawing the money, going to your bank and depositing the money for your needs, you can just write yourself a check from the special checkbook, then deposit it into your checking account at your other bank. And that would be a way to transfer the money from the line of credit to your checking account at another bank. Any questions on that?
Is there a fee for in-person withdrawal?
We do not charge the line of credit any fees for withdrawal. Did that answer the question? I hope.
Yes, perfect.
Okay, great. Any other questions on anything we talked about? I can jump back and forth from topic to topic. I'm cool with that. All right. So if you are thinking about applying, if you decide you do want to apply, you can go to our website to do an online application. You can give me a call. My phone number is up on the screen now. My email is on the screen now. If you have further questions you feel more comfortable asking privately, you can certainly call me or email me. I'd be happy to answer any other questions you have, or I can take the application with you over the phone for you if you're not comfortable doing online things. I get that too. Any questions or comments? I kind of talk fast, so I might, if I rush through anything, let me know if you need further explanation on something.
All right, I think we're good, Jen.
All right.
So a very big thank you to you, Jen, for hosting this webinar, and another big thank you to all of you for joining. We will be sending you a follow-up handout that goes over what we just discussed today, and it will also have Jen's contact information and ways to apply. We will also be pulling the winner of the $100 Home Depot gift card, and we will contact you within the next few days. Oh, and I actually do think that we had a question come through.
Oh, okay. Yeah.
Oh, Annie, I hope that did just answer your question. We will be sending a follow-up email.
Oh.
All right, perfect. Well, thank you again, and I hope everyone has a great night.
Thanks. Good night.
Good night, guys.